All right, let's get into it. Today, we're going to play detective and try to crack the technical code behind Pfizer stock, PFE. We're going to dig right into the charts, into the data, and see what story the numbers are really trying to tell us.
So this is the big question, right? If you strip away all the news, all the headlines, all the noise, what is the cold, hard data actually telling us about where Pfizer stock is and maybe, just maybe, where it's headed next?
Instead of making you wait until the very end for the big reveal, we're going to do things a little differently today. We're putting the answer first. Let's get the main conclusion right out on the table right now.
And boom, there you have it. The whole story here boils down to a conflict. On one hand, the stock is definitely in a downtrend, no doubt about it. But, and this is a big but, that trend is really weak, and there are some fascinating clues that a turnaround could be brewing. It's this tension that makes PFE's chart so compelling at this very moment.
Okay, before we dive any deeper, let's just quickly check the vitals. The beta tells us it's less volatile than the market as a whole, and it's sitting pretty much in the middle of its price range for the year. But whoa, look at that risk/reward ratio. A number over 24 is, well, it's exceptionally good. It's a huge statistical hint that even with the downtrend, the potential reward for anyone buying in might heavily outweigh the risk.
So let's start gathering our evidence. First up, we're going to follow the money. This means looking at the relationship between the stock's price and its trading volume, because that tells you how much conviction, how much oomph is really behind these price moves.
And to do that, we have to talk about something called VWAP, the volume-weighted average price. The easiest way to think about it is as the stock's financial center of gravity. It's not just an average price. It's the specific price where the most money, the most shares have actually changed hands. It's a really important level.
Now, look at this number. Pfizer is trading more than 28% below that critical VWAP level. That is not a small dip. That's a huge gap. It's a massive clue that sellers have grabbed the steering wheel and yanked the price way, way down from where all the real action was happening.
And this isn't just us guessing. The analysis itself confirms it. When you hear a phrase like strong distribution pressure, that's just technical jargon for a lot of people are selling and they mean it. The high volume we're seeing isn't from people buying the dip, it's from people getting out.
So this is where it gets a little tricky. The analysis calls this a volume trap. You see all this high trading volume and you might think, oh wow, there's a lot of interest. But when you look closer, that volume is being driven by selling. It's a total head fake, and it's our first major piece of bearish evidence.
Okay, so sellers are in charge. Got it. But how powerful is this downtrend really? Let's pull out our next set of tools and try to decode the trend.
And wow, this slide perfectly captures the entire puzzle. On the left, the Aroon Oscillator is at -100. That's as low as it can go. It's screaming, we are in a downtrend. But then on the right, you look at the ADX, which measures the strength, the horsepower of the trend, and it's just barely chugging along at 11.42. So yeah, the car is rolling downhill, but it's like it's in neutral with no foot on the gas.
And if you needed any more proof of that downtrend, just look at the moving averages. The short-term averages are all trading below the long-term ones. It's a classic textbook bearish setup. It just adds more weight to the idea that, for now, the path of least resistance is down.
So the direction is down, but the strength is weak. Okay, what about the energy behind it all? Let's check the engine's RPMs, so to speak. Now we're going to look at momentum.
Trying to look at a dozen momentum indicators at once can make your head spin, right? So this chart sums it all up for us. And you can see it's a really mixed bag. Half of the signals are weak sell signals, which totally fits with our weak downtrend story. But look at that other big chunk. 30% is flashing oversold. And this is where things get really interesting.
So what does oversold actually mean? The rubber band analogy is absolutely perfect. Imagine sellers have been stretching that band down and down and down. The more they stretch it, the tighter it gets, and the more tension builds for a potential snapback rally. Now, that doesn't guarantee it will snap back, but that potential energy is just coiled up, waiting for something to happen.
And we're not just talking about a little stretch here. I mean, look at these numbers. The Stochh RSI is at 0, the absolute floor. The Williams %R is way down below -80. This is probably the strongest piece of bullish evidence we have. This is the data screaming that the rubber band might be stretched to its absolute limit.
So let's put it all together. We've got this weak but confirmed downtrend on one side, and on the other, we have these screamingly loud oversold signals. It's a standoff. So based on all these clues, what are the most likely ways this whole thing could play out from here?
Well, before we talk scenarios, we need to know the battlefield. These are the key price levels to watch. You've got your ceiling, which is resistance, at 24.61. You got the floor, support, at 24.06, and right now we're just kind of hanging out in the middle. These three numbers are going to tell us who's winning the fight.
And here they are. Our detective work leads us to three potential outcomes. 1, the bullish case. That rubber band finally snaps, and the price punches right through that resistance level. 2, the bearish case. The weak downtrend just keeps on grinding lower, and the price breaks below that support floor. Or 3, the sideways case, where the two sides are so evenly matched, they just get stuck in a stalemate, with the price chopping around between those key levels.
And this brings us right back to the heart of the entire story. The whole technical picture for Pfizer right now boils down to this one single conflict. You have a clear downtrend with heavy selling pressure going head-to-head with a stock that is deeply, deeply oversold and just begging for a rally.
So, we'll end on this question. We've laid out all the evidence. We've seen the bearish volume, the weak trend, and the extreme oversold momentum. Now the real question is, which one of these powerful forces is going to win this tug of war? The chart is telling us something has to give, and that the next move could be a decisive one.